If you had been given the chance to buy a serious quantum computing stock in 2023 when it was trading for less than $1 before the headlines arrived, before the large technology companies started talking about the sector openly, and before the crowd began treating quantum like the next great market story, what would you have done? Most people would say they would have bought it. That is easy to say after the fact. It is easy to look at a stock that later rose more than 2,000% and say, I would have seen it. It is easy to look at a $10,000 investment that could have turned into more than $224,000 and believe the decision would have been obvious. But the truth is that in real time, the biggest opportunities almost never feel obvious. They feel uncertain, they feel early, they feel uncomfortable. They usually sit in a corner of the market where most people are not looking, and when you explain them to others, they often sound too speculative, too strange, or too far away. That is why most people miss them. They do not miss them because they are unintelligent. They miss them because they wait for comfort. And by the time the opportunity becomes comfortable, the price usually reflects that comfort. This is one of the most important lessons in investing. The greatest returns are usually available before the crowd has enough social proof to feel safe. That does not mean you should buy every speculative idea early. That would be foolish. It means you need a process for distinguishing between a weak early idea and a strong early signal. That is what I want to walk through here. A call made before the crowd arrives tells you something. It is not just a lucky receipt. It can be what I think of as a woodshed signal. When a musician walks onto a stage and plays beautifully, the audience does not see the years spent practicing alone. But the performance reveals the preparation, the result carries the evidence of the work that came before it. Investing works the same way. Anyone can talk about quantum computing after NVIDIA makes announcements, after the sector begins to explode, after the stocks are already running, and after retail investors start looking for the next 10-bagger. But making the call when these companies are trading under $1, when they are ignored, when the market does not yet care, that is the woodshed. The preparation is built into the result. So the real question now is not whether one quantum stock already moved. That part is history. The real question is what that move is telling us about the structure of the opportunity going forward. And the structure has changed 6 months ago. There were only a few publicly traded quantum pure plays. The field was narrow. If you wanted direct exposure to quantum computing, you had very few choices. That meant investors were often forced into one or two names, whether or not those names represented the best architecture, the best balance sheet, or the best commercial opportunity. Today, the field is broader. There are more public quantum companies. More are expected to come through the IPO pipeline. And for the first time, investors can begin to map the sector across several different technical approaches instead of blindly betting on a single company that matters. When a sector goes from a few isolated public names into a broader investable ecosystem, the investment problem changes. It stops being only a question of which ticker sounds exciting. It becomes a question of architecture. Customers, manufacturing, cash burn dilution, software adoption, infrastructure leverage, and timing. That is where most retail investors get lost. They begin with the stock symbol. Serious investors begin with the system. I have learned through cycles that if you begin with the ticker, you are already downstream of the most important thinking. You are reacting to price. You are reacting to excitement. You are reacting to a story that somebody else has packaged for you. The better process is to begin with the machine. What problem is being solved? Which method is being used to solve it? Who is paying for it? How far is the technology from commercial scale? How much capital will be needed before the company can stand on its own? Who controls the enabling infrastructure? What risks could make the story fail even if the technology itself is real? Those are the questions that matter. Before we look at the companies, there is a decision rule that is useful here. It comes from mathematics and is sometimes called the 37% rule. The simple version is this. When you face an important decision under uncertainty, spend the first part of the process observing. Do not rush to commit. Watch, learn what good looks like. Build a baseline. Then, once you have a baseline, you are more capable of recognizing when something appears that is better than what you have already observed. This is very relevant to quantum investing. Most people do not do this. They do not observe first. They react first. They see a chart go vertical. They see a headline. They see someone say that a company could be the next NVIDIA. They feel the fear of missing out. Then they buy before they understand what they own. That is not a framework. That is emotion with a brokerage account. The 37% rule teaches patience without paralysis. It does not tell you never to act. It tells you to watch long enough to know what you are acting on. Quantum computing is exactly the type of field where that matters because quantum is not one single technology. It is several competing technological paths trying to solve a set of extremely difficult computing problems. Different companies are using different architectures. Different architectures have different strengths. Different strengths imply different use cases. Different use cases imply different timelines. And different timelines create different investment risks. If you do not understand the architecture, you do not really understand the investment. That is the first principle. There are several major approaches to building a quantum computer, and for the first time, they are becoming publicly investable across the spectrum. One of the most important established names is D-Wave Quantum. D-Wave is the example many people now look at because it was one of the quantum stocks that traded under $1 before making an extraordinary move. But instead of getting mesmerized by the move, we should understand what the company actually does. D-Wave uses a superconducting approach called quantum annealing. That phrase can sound complicated, but the investment idea is simpler. Its systems are designed to solve optimization problems. Optimization matters in the real economy. It can affect supply chain routing, drug discovery scheduling, portfolio risk modeling, logistics, and other problems where the number of possible solutions becomes too large for classical methods to handle efficiently. This is important because D-Wave is not only selling a dream about a future machine that may someday work. Customers are already using its technology today for certain categories of problems. That does not make it safe. Early-stage technology companies are never safe, but real customer usage changes the nature of the analysis. It gives you something to measure beyond imagination. Reported revenue growth was strong, and the early 2026 contract momentum was even more interesting. The company reportedly booked more in new contracts during January and February than it generated in the entire prior year. When I see something like that, I do not immediately turn it into a buy decision. I treat it as a signal. It could mean adoption is accelerating. It could mean customers are moving from experimentation to commercial use. It could mean quantum optimization is beginning to find real economic pull, or it could be a temporary spike that the market overinterprets. The investor's job is to test which explanation is more probable. That is how you think in probabilities instead of narratives. D-Wave also added another layer by acquiring capability that gives it exposure to gate model quantum computing alongside its annealing system. This matters because in an uncertain technology field, optionality is valuable. A company tied to one path can be highly exposed if that path loses favor. A company that can build competence across more than one approach may have more ways to survive. Survival matters in frontier technology. Survival is often the bridge between early promise and later commercial value. Many investors focus only on upside. They ask how much the stock can rise. I first ask whether the company can survive long enough for the upside to matter. The second major name is IonQ. IonQ uses trapped ion technology instead of superconducting circuits. It uses individual atoms held in place by electromagnetic fields. Trapped ion systems are known for precision and high fidelity. That matters because quantum systems are extremely sensitive to errors. IonQ is one of the largest quantum pure plays by both revenue and market capitalization. That gives it legitimacy, but also higher expectations. The market is already paying attention. When a company's backlog increases significantly and revenue grows strongly, those are meaningful data points. When the company moves toward owning more of the manufacturing process, that can be even more significant. IonQ's reported acquisition of Skywater Technology points toward a broader strategic idea in advanced technology cycles. Controlling manufacturing can become a moat. This is true in semiconductors. It is true in defense technology. It is true in AI infrastructure, and it may be true in quantum computing. If IonQ can control more of its manufacturing chain on US soil, that can matter for Pentagon contracts, government procurement, national security priorities, and supply chain trust. Defense customers think differently from retail investors. Retail investors ask, will the stock go up? Defense customers ask, can this system be trusted? Can it be built securely? Can it be scaled? Can it be protected from foreign dependence? Those questions are not glamorous, but they are very important. So when I look at IonQ, I look not only at the technology and revenue, but at whether the company is moving from a science story toward an infrastructure story. That transition is often where value begins to compound. The third established name is Rigetti Computing. Rigetti uses superconducting gate model technology. This places it in a large and important technical category, but it also places it against extremely serious competitors, including IBM and Google. That does not mean Rigetti cannot succeed. Small focused companies can sometimes move faster than giants. But the competitive context matters. There is also customer concentration risk. If a large portion of expected revenue depends on a small number of contracts, then delays matter. In quantum hardware, delivery timelines can shift because the engineering is difficult. That is part of the territory. But as an investor, you must not ignore it. If you own Rigetti, you are underwriting a specific roadmap. You are underwriting its ability to execute against larger players. You are underwriting contract delivery. You are underwriting its ability to preserve credibility through delays. That is a very different bet from simply saying, I own quantum. The label does not define the risk, the execution path defines the risk. The fourth established name is Quantum Computing Inc., trading under CUPT. Here I would be especially careful. This is a very high-risk name. Reported revenue was extremely small, and filings included serious warnings. There have also been securities fraud lawsuits and allegations that certain relationships or revenue claims were overstated. Those are not small details. In speculative sectors, the market can sometimes reward the most exciting story before it rewards the strongest business. That can create enormous short-term moves, but it can also create dangerous traps. A company with a compelling name is not the same as a company with a durable business. A company in the right sector is not automatically a good investment. A stock can go up because of excitement. A business compounds because of fundamentals. You must know which game you are playing. That completes the older public group. But the more important development now is that new entrants are bringing additional architectures into the public market. This broadening is what makes the sector more analyzable. The first new entrant to understand is inflection. Inflection uses neutral atom technology. Neutral atom systems are interesting because they may have a scaling advantage. The potential to reach large numbers of qubits without some of the engineering nightmares associated with other architectures is one of the reasons investors and institutions are paying attention. But the company is not only a neutral atom story, it also has quantum sensing that matters because sensing can create nearer-term applications while quantum computing continues to mature. This gives the company two possible commercial tracks. In early-stage technology, this can be important. A second revenue stream can help validate engineering capability, build customer relationships, and provide commercial traction before the larger computing opportunity fully matures. Inflection also has meaningful institutional attention, including selection by NVIDIA for quantum programs. I would not treat that as a guarantee. Nothing in investing is a guarantee, but I would treat it as a data point. When NVIDIA pays attention to a company in advanced computing, I pay attention too. Not because NVIDIA is always right, but because NVIDIA is becoming a central infrastructure player in the AI and advanced computing ecosystem. Its choices can influence where developers, customers, and investors look next. The second new name is Xanadu. Xanadu uses photonic quantum technology. Photonic systems use particles of light, and one of their appealing engineering features is that they can operate at room temperature. That may reduce some of the cooling problems that other architectures face. That is a real potential advantage if it scales. But the part of Xanadu that interests me most is software. Xanadu built Penelane, an open-source quantum programming framework used by a large portion of quantum developers. Usage has grown significantly, and the download numbers suggest that it has meaningful adoption. This matters because software can sometimes become the layer that benefits regardless of which hardware architecture wins. If you are uncertain about hardware outcomes, it can be valuable to study the tools used across the field. A hardware company has to be right about its machine. A software platform can sometimes win as long as the ecosystem grows. That does not remove the risk. Xanadu is still early, revenue is still young, the stock has been volatile, but the software layer gives it a different kind of optionality. I like optionality when it is attached to real adoption. The third new name is Horizon Quantum. Horizon is more of a hardware-agnostic quantum software company. In plain language, it builds tools that can work across different quantum architectures. That makes it a middleware-style business. Middleware is easy to overlook. Investors often focus on the hardware because it feels more dramatic, but in many technology cycles, the connecting layer between hardware and users becomes extremely valuable. It happened in cloud, it happened in software, it happened in AI, it can happen in quantum. The key question is whether Horizon's tools become necessary rather than merely interesting. That is always the transition that matters in software. Interesting tools get attention. Necessary tools get budgets. Then there are the quantum security companies. These include names working on post-quantum encryption chips and quantum safe key distribution. The logic is straightforward. If quantum computers eventually become powerful enough to threaten today's encryption, then governments and enterprises will need protection before that threat fully arrives. This is a real theme, but many of these companies are very early, pre-revenue or close to pre-revenue. That means the risk is high. You are not buying current earnings, you are buying a possible future demand curve that can work, but only if it is sized correctly. The size of a position should reflect the maturity of the business, not the excitement of the story. This is where many investors lose discipline. They put too much money into the least proven part of the opportunity because the upside sounds largest. That is not strategy, that is emotional leverage. There are also major IPOs expected in the sector. Quantinuum, majority owned by Honeywell, has reportedly filed confidentially and may target a very large valuation. IQM out of Finland and Pascal out of France are also expected to come public through SPAC structures. If these companies enter the market, the public quantum universe could expand materially by the end of 2026. That would be an important milestone. More companies mean more data, more architectures, more financial disclosures, more customer comparisons, more ways to build a portfolio across the field. In the earliest stage of a sector, investors trade stories. In the next stage, investors compare execution. Quantum appears to be moving toward that next stage. That is good for serious investors and dangerous for careless ones, because as a sector matures, the market eventually stops rewarding every name equally. It separates the companies with real traction from the companies with only language. That separation can be brutal. Now there is another layer that may be even more important than the pure plays, the infrastructure companies. Amazon Web Services hosts multiple quantum hardware providers. Microsoft Azure does the same. NVIDIA software platforms integrate with a large share of quantum processors, and its venture arm has backed important private quantum companies. These companies are not pure quantum bets. They do not need quantum computing to succeed. But if quantum succeeds, they can become toll collectors. This is one of my favorite types of exposure in an uncertain technology cycle. When you cannot know which architecture will win, it can be rational to own the layer that benefits from many architectures. In a gold rush, the miners may make the spectacular discoveries, but the people selling tools and access often earn steadier returns. That does not mean infrastructure stocks will outperform the best pure play. They probably will not if a pure play becomes a true category winner. But infrastructure can provide a better risk-adjusted path because the downside is not tied entirely to quantum. That is the trade-off. Pure plays give you more upside and more fragility. Infrastructure gives you less direct upside and more resilience. A serious portfolio thinks about both. Now we return to the practical question, are quantum stocks still attractive entry points today? The answer is maybe. I know people want more certainty than that. They want a list, they want a buy price, they want someone to remove the uncertainty, but uncertainty cannot be removed. It can only be managed. Some quantum stocks have already moved dramatically, some have corrected, some new public companies have entered the market, some IPOs may soon expand the field further. Commercial traction is improving, but the sector still has high cash burn, high dilution risk, high technology risk, and high valuation risk. At the same time, the opportunity is real. That is the tension. Good investing is not about eliminating tension. It is about thinking clearly inside it. This is where the 37% rule comes back. If you watch the field long enough to understand the architectures, the companies, the revenue quality, the risks, and the infrastructure layer, you now have a baseline. Most people do not have that. Most people only know the headline. They know that quantum sounds powerful. They know a stock went up. They know some investor on the internet says it could be the next AI boom. That is not knowledge. That is exposure to noise. The look phase gives you something better. It gives you a way to separate signal from noise. It also helps you recognize your own psychology. 6 months ago, the dominant fear in quantum was, what if it does not work? What if the science never gets there? What if the companies burn through cash before the technology becomes commercial? What if the market is too early? Now the fear is shifting. The new fear is, what if it works and I am not in it? That is the most dangerous emotional moment. The same companies can have the same risks. But the crowd as fear has changed direction. The fear that kept people from buying near the bottom becomes the fear that pushes them to buy near the top. When you feel that inside yourself, pause. A pause is not weakness. A pause is where judgment comes back. Ask one question. Is the decision I am about to make calibrated, or is it emotional? That question alone can save people a great deal of money. Every early-stage quantum company faces the risk of cash burn and dilution. Many will need to issue shares to fund research, engineering, manufacturing, and commercialization. Even if the stock price rises, your ownership can be diluted if the company keeps selling equity. That is not unusual. It is common in early hardware businesses. But you must distinguish between good dilution and bad dilution. Good dilution funds progress. Bad dilution funds survival without progress. If a company raises capital and converts that capital into contracts, systems, customers, and a stronger roadmap, that is one thing. If it raises capital just to keep a story alive, that is another. The market may not tell the difference immediately, but eventually it will. If I were thinking about quantum allocation today, I would divide it into layers. Not because any allocation is perfect, but because layering helps match risk to probability. If I had $100 specifically allocated to quantum exposure, the largest share would go to infrastructure. That is the anchor. The infrastructure companies have real cash flow today. They have existing businesses. They can benefit from quantum if the field grows. But they do not depend on quantum for survival. That matters because the timeline in quantum may be longer than the hype suggests. The second layer would go to pure play builders. These are the companies where quantum is the entire business: D-Wave, IonQ, Rigetti, Inflection, Xanadu, Horizon, and others as the field expands. This is where the largest upside could emerge if commercialization accelerates. It is also where failures will be most severe. That is the price of direct exposure. The third layer would be the dream layer. This would include the smallest, earliest, most speculative names: quantum security, pre-revenue company, highly uncertain microcap stocks where one breakthrough could multiply the investment, but where the capital could also disappear. This layer must be small. Speculation is not automatically wrong, but oversized speculation is how people turn an opportunity into a disaster. There are also quantum ETFs for people who do not want to pick individual companies. A basket can reduce company-specific risk, though it cannot eliminate sector risk. If the whole sector is overvalued or the timeline disappoints, the ETF can still fall. But for many investors, owning a basket can be more rational than pretending they can identify the one winner. When you cannot know the winner, sometimes owning the field is better, but only at the right size, and only if you understand the field. That is the point. The lesson of a past 10-bagger is not that every quantum stock will become a 10-bagger. The lesson is that frontier sectors can create enormous returns when the market misprices them before adoption becomes obvious. But the same frontier sectors can also destroy capital when investors confuse the existence of a real theme with the quality of every company attached to it. The internet was real. Many .com stocks still went to zero. AI is real. Many AI stocks will still disappoint. Quantum may be real. That does not mean every quantum company will survive. A sector can be right and a stock can be wrong. That is one of the hardest lessons for retail investors. They hear a good thesis and assume every stock connected to that thesis is good. That is not how markets work. The thesis gives you the pond. The company still has to be the right fish. So I would approach quantum with seriousness, curiosity, and discipline. I would not chase blindly. I would not dismiss it as too early. I would map the system: superconducting annealing, superconducting gate model, trapped ion, neutral atom, photonic software, security, infrastructure, IPO pipeline, revenue, backlog, cash burn, dilution, customer quality, balance sheet valuation. That is the sequence. The ticker comes last. Most people want the ticker first because the ticker gives them the illusion of action. But action without understanding is not progress. It is movement. There's a difference. Quantum computing may become one of the most important technology platforms of the next decade. It may create new winners. It may also create enormous disappointment for investors who arrive late, size incorrectly, and buy stories instead of systems. Both outcomes can happen at the same time. That is why the right approach is not all in excitement and not total avoidance. It is structured exposure. You want enough exposure to benefit if the thesis works. You want enough discipline to survive if the thesis takes longer, moves differently, or destroys weaker companies along the way. That is how I would think about it. Do not worship the 10-bagger. Study the conditions that made it possible. Do not chase the applause. Study the woodshed. Do not buy because you are afraid of missing out. Buy only if the decision is calibrated, sized, and connected to a framework you actually understand. The future does not reward people for being excited. It rewards people for being prepared. And in a sector like quantum, preparation is the edge most people will not have.